74.6%. That's how far Netflix fell. From $69 in October 2021 to 17.55 by June 2022. Today the stock sits near $70, more than triple that low. This is how it broke and how it came back. So, where's the high watermark? Picture a blockbuster counter in 1997. Reed Hastings owes a $40 late fee for Apollo 13. The sting wasn't the money, it was the system. So he and Mark Randolph built a subscription model instead. One flat fee, no due dates, discs mailed to your door in red envelopes. In May of 2002, Netflix rang its opening bell, pricing shares at $15 and raising $82.5 million. The company had 600,000 subscribers and was losing money. What investors were really buying wasn't DVDs by mail, it was a decade early bet on internet delivery. Broadband in 2002 reached barely 1 in 9 American households. Too slow to stream a film. Netflix spent years building a bridge to a future that hadn't arrived yet. In a 2005 earnings call, Hastings said it plainly, and I'm quoting: our core strategy is to lead the transition to internet delivery of video content. When content partner Stars demanded a massive price hike in 2011, Netflix said no, and 1,000 movies vanished from the service overnight. The stock dropped 35% that quarter. The lesson was blunt. You cannot build a lasting business on content you merely rent. So Netflix outbid HBO and AMC for House of Cards, committing $100 million for 2 seasons before a single frame was shot. David Fincher directed, Kevin Spacey starred, and when it premiered on February 1st, 2013, it won 3 Emmys. Netflix had stopped being a distributor and become a studio. The flywheel was spinning by October 2016. Quarterly streaming revenue topped $2 billion for the first time, up 36% year over year. The shareholder letter named the reason plainly, and I'm quoting: our strong content slate, including Stranger Things and the second season of Narcos. The stock jumped 25.7% that week. By mid 2017, Wall Street had modeled 3.2 million new subscribers for the quarter. Netflix added 5.2 million instead and crossed a symbolic line: 100 million members worldwide, with international users now outnumbering domestic ones for the first time. Then came the blowout quarter: 8.33 million new subscribers in the last 3 months of 2017, smashing the 6.4 million Wall Street expected. Full year streaming revenue had grown 36% past $11 billion. Hastings called it a beautiful Q4. The stock jumped 24.6% that week. Look at this point on the line: January 2022. Netflix forecast just 2.5 million new subscribers for the coming quarter, against the 6.26 million analysts expected. A guidance shock that rattled the market. Executives called themselves optimistic about long term growth. The market wasn't. Shares fell 24.4% that week. 3 months later came the real shock. Netflix had lost 200,000 subscribers in a single quarter, its first decline in more than 10 years, and it warned of 2 million more losses ahead. The letter admitted revenue growth had slowed considerably. The stock collapsed 36.8% that week. By June 12, 2022, the stock closed at $17.55, 74.6% below its October peak. And this was the bottom: 221 million subscribers, and still the market asked whether Netflix was even a growth company anymore. Password sharing alone was estimated to touch 100 million households. $17 billion a year, that was Netflix's content budget in 2022, roughly the size of a small country's economy, and it was buying less growth than ever. So the company reversed two philosophies it had defended for years. Ads were coming, and password sharing was about to cost extra. Then a reversal. Netflix added 2.41 million subscribers in the third quarter, beating its own forecast. Executives wrote carefully, and I'm quoting: after a challenging first half, we believe we're on a path to re accelerate growth. The stock rose 25.9% that week, though the company was still deep in the woods. Two changes did the work no ad campaign could. In November 2022, Netflix launched an ad supported tier at $6.99 a month, $3 cheaper than ad free. In May 2023, it rolled out a global password sharing crackdown, charging freeloaders $7.99 a month or cutting them off. Analysts braced for revolt. The revolt never came. Netflix added 13.1 million subscribers in the last quarter of 2023, its best gain since the pandemic surge. Free cash flow hit $6.9 billion for the year, up from $1.6 billion in 2022. The stock jumped 18.1% that week. On June 30th, 2024, the stock closed back above $69.03, the old high, reclaimed nearly 3 years after the crash began. There was no single headline that day, just analyst upgrades and a market finally believing the new model would hold. From 221.6 million subscribers at the depths of the crisis to 300 million by 2026, that's the shape of the rebuild. On February 22nd, 2026, the stock rose 22.3% in a week, closing at 96.24 as the market bet on the moat Netflix had built. Days later, Netflix walked away from a bidding war for Warner Bros. Discovery's live sports rights. Co-CEOs Ted Sarandos and Greg Peters said the price had become, and I'm quoting, no longer financially appealing. The message: discipline over chasing the last piece of the puzzle at any cost. And that's where the line stands.